Hello everyone, thanks for coming. Today we're going to give a short review of the annuity chapter. Actually, the first part of the annuity chapter. So first, we learn the term annuity. The term annuity is a present. We need to calculate the present value, the small a, the present value of annuity paying $1 annually for 8 years. And this is for the term annuity paying at the beginning of each year. Also, if the annuity is to pay m times a year, and for each payment is $1/m, then we'll have the bracket of m in the superscript. Also, we have two different versions. AM paid at the end of the year, and if it's paid for if it's paying $1/m for m times per year, then we have a bracket of m in the superscript. So in contrast to the term annuity, we also have the whole life annuity, which is to pay the insured life throughout its life. We have the small a of x, the present value of annuity, paying $1 annually through the whole life. And the payment is at the beginning of each year. We have the formula that connects the whole life annuity with the term annuity. But note here that because we have an x in the subscript, it means we need to consider the survival probability. But for the term annuity notations, we don't have that x, so we don't need to consider the survival probability. Also, a variant is a term whole life annuity payable at the end of each year, so that is denoted by a of x. It's just the present value of the annuity paying at the beginning of each year minus 1. Also, we have the whole life annuity paying $1/m m times per year. We have the annuity immediate, which means that the annuity will pay immediately after the insured life purchase the annuity, and also the annuity paid at the end of each period. So for the whole life annuity immediate, we have AX equals to AX dot minus 1. For the term annuity immediate, we have the term annuity payable at the end of each period, AX to N equals to V times PX times A dot the term annuity immediate starting from X plus 1 years old and lasts for another n years. Also, another variant is payable m times a year with $1/m per time. So we also have similar formulas. The annuity continuous means that the annuity will pay continuously throughout the year. We denote the expected value of the annuity paying $1 continuously per unit of time by AX bar. So AX bar equals to 1 minus capital AX bar over delta. Delta is the interest rate for continuously compounding, and AX bar is a whole life insurance. Also, another formula for calculating the small AX bar is the integration of Vt times the survival probability Tpx dt. For term annuity, We also have the continuous version. The definition is small ax bar from x to n. It means paying continuously for n years or till death. So if the expected life, remaining life, smaller than n, then small a bar from x to n will be 1 minus v, the discount factor, to the power tx over delta. Delta is the continuous compounding interest rate. So if tx is larger or equal than n, then because the payment will stop after n years, so the present value will be 1 minus v to the power n over delta. Also, we have another formula, which is 1 minus the term insurance paying immediately after x, which is capital A bar from x to n over delta. Thanks for listening.